Hi guys, good evening and welcome to Moneycontrol Markets Weekly. I'm Karunya Rao, and this week has been quite interesting for the Indian markets, for the global markets as well. We started on a firm footing, but global markets have given up this week's gains to a great extent. Europe and US both have been witnessing some weakness in the last couple of sessions. Similar sentiment actually, sort of coming across as far as the last week is also concerned. But it's the US economy data that has been hogging a fair amount of limelight, which has also marred the sentiment to a great extent. Let's talk a bit more about the numbers, what they mean, how should one read into the macros, and what will be the impact on the stock markets, not only in global equity markets, but also back home on the last week as well. Let's welcome on board my colleague Anubhav Sahu from MC Pro and Santosh Rao from Manhattan Ventures. Good evening, guys, and thank you so much for
Really.
taking time out. And good morning to you, Santosh. I know you're joining from New York, so
Good
thank you
morning.
so much for logging in early in the morning for us.
My pleasure. Thank you. Thanks for having me.
So I want to start with you, Santosh, first. In the last couple of days, the macroeconomic data coming in from the US definitely pointing to a slowdown. So talk to us about how we should approach this data and what should investors make of it.
Sure. I think about the data, I think one important data point that will be coming out soon will be the second quarter GDP data. If we have 2 quarters of decline, then it's an official recession. So at this point, we don't know. I think the fourth quarter of last year was about close to 7%. Last first quarter, we dropped about 1.6%, negative 1.6%. So the people are hoping that this one will not be negative. The Atlanta Fed has said it's going to be flat to down. So things like that. So I think that is one data point that people will be watching. But overall, as you know, the sentiment is about slowing down, or the policy is about slowing down the economy. There is inflation, rampant inflation in the services sector, whether it's rent, whether it's food, whatever. I think services inflation is really hurting people. Goods inflation is kind of slowing down, but the supply chains are easing a little bit, but it's still there. But overall, inflation is there. There are some bottlenecks. China is still not totally operational. Oil prices are still high. Maybe right now there's a slight slowdown, or kind of not going too high, but the trend is still up. And then the war is still going on. So the macro, the headwind is very strong still. So the market, we are expecting a continued slowdown. The rates are going to go up. The Fed is going to raise rates another 75 basis points. So overall, I think things are towards slowing down. Things are moving towards a slowdown. Maybe not recession. If not a recession, at least a stagflation looks like. But over the word of recession not yet final yet. But things are bad in that sense. So and that will have a spillover effect on the international markets as well. If the dollar keeps going up, interest rates keep going up, I think that has a spillover negative effect on the Indian markets as well. So I think that's the setup right now. Very cautious right now. Inflation in the air, recession in the air, and caution is the operative word.
Okay, all right. But what are the estimates that you are working with? Yes, chances are low for second consecutive quarter of degrowth because that would officially mean that we are in a recessionary phase. But there has been a downward revision of estimates for Q1. There's moderation in household consumer spending as well. So, what are your estimates that you're working with right now?
Yeah, I think it'll continue to go down. The estimates are definitely pointing to a slowdown. I think the worst thing that can happen with inflation is not just the absolute number, it's the sentiment behind the
Yeah.
inflation. What happens is the people will slow down, they expect things to get worse, the companies cut back, capex slows down, layoffs start. So that the spillover knock-on effect of the expected inflation is worse than the actual absolute number. And I think that's what we are seeing. Companies today, Facebook announced that they are going to cut back on engineers, things like that. All the big cap, well capitalized companies are also slowing down. Tesla announced layoff. So tech is already affected. And there are some news everywhere else also. So I think what we are expecting is let's see. I think another big data point that people are waiting for is the last pillar of this whole economic scenario is the earnings reports. They come out in 2 or 3 weeks. They've held up pretty well. There haven't been much downward revisions. They're just beginning, but they haven't been. Overall, the street is still expecting about 8 to 9% EPS growth in 2022. So I think that's very optimistic. So I think this second quarter will give us a good window as to what the companies are expecting, how much the inflation has affected their balance sheets and their profit and loss statements. So I think we still have to wait for a couple of weeks just to see between the Fed meeting, the earnings reports, and all that. I think that everything is pointing to soft numbers, down numbers. If there is any positive sign, that will be good. The best positive sign can be a decline in energy prices, and just improvement overall in terms of demand. But I think that doesn't seem to be anywhere. Even the housing is slowing down.
Yeah.
Everywhere is slowing down. So net, I would say the whole big hope is that it's not falling too much and it's falling gradually. And the Fed hopefully will not go all in, will recalibrate their policy and not go all in and keep on raising rates when the whole economy is slowing down. So that's the hope, that the Fed is going to see the market and say, you know what, maybe we don't need to raise too much. The
Yeah.
market is doing it for us. I think that's where we are.
Anubhav, what is your assessment of the situation? What are the chances of US economic recession and what are the macros pointing to?
Yeah, so Karunya, like you said, I think in the last few days we talked data down. Consumer spending per se household consumer spending has moderated, in fact, is lower than in the earlier numbers have been revised down. In fact, reason we talked about the Q1 data,
I think we'll have to, Anubhav, there's some, issue with your audio, it seems. You'll have to fix that. I'll come back to you in a moment. Just see if your network is stable, and we'll get back to you. But meanwhile, Santosh, I want to understand how are, people sitting in the US and people in larger economies looking at EMs right now. Because if we look at the way the markets have panned out, US vis-a-vis India, for instance, India has managed to outperform. The decline YTD is not as bad as, if you look at the quantum of decline the US markets have seen. Nifty and Sensex both, I think they shed 9% each so far, whereas Dow is down about 15%, S&P is down 21%, Nasdaq is down 30%. Will that outperformance mean that markets like India perhaps are going to be a more attractive destination in times like this?
Absolutely. I think amongst the emerging markets, I think India is definitely one of the well-managed companies. They have no credit issues, they have no liquidity issues, so they can sustain that, unlike some of the neighboring countries. So I think in that sense, India is managed very well. I think the people see that. The only there also, I think recession fears will keep on coming there. Uh, it's a huge population. They can. I think there's a big advantage to that as well on the demand side. Uh, but I think in the end, people it will spill over at some point, if not through at least through the exchange mechanism, the flow mechanism. Also, I think that will slow down things. But if the energy prices, I think right now in U.S., India is benefiting from energy. It hasn't impacted them as much as the other countries, as the European countries, because they're getting oil at a much better price, because of their relationship with Russia. So let's see where that goes, how that goes, and hopefully that will settle. So that pressure, if that goes, I think it will definitely be helpful to India. So they have managed well in that sense. But overall, I would say the wind is going to blow across the world. Inflationary pressures are high, and US is, like they say, the cleanest shirt in a dirty laundry basket, as the saying goes. So I think US will drive the whole thing. What happens here will have a spillover effect everywhere, but to some extent India will be able to manage it better than other emerging markets that are more dependent on the dollar, and their all their debt is tied to the dollar. They have dollar debts. So I think things like that. There are a lot of issues in that sense, but at a very high level, I think a healthy US and a healthy and a stable inflationary environment and a interest rate environment will help the overall market.
Okay, all right. And how should one look at market valuations right now? And what should be an investor, a retail investor strategy? Because there are red flags all over, irrespective of which part of the world we're sitting at or which market we are trading or investing in. Inflation, recessionary fears, there's supply chain concerns. So a lot of these headwinds and a lot of these challenges are common across the board. So what should be an investor, a retail investor strategy at this juncture?
Yeah, I think defensive is the best strategy at this point, and staying liquid. Cash is really important at this point. But in terms of valuation, I think what's happening in US is the S&P, which is the 500 large cap companies, best large cap companies, that multiple is coming down to maybe closer to 15 times forward earnings, which is the historical average in this type of environment. So if that gets there, and I think at the S&P level is about 3,500, 3,300 to 3,500. That's what the estimates are, the projections are in general. If things break below this level that we are in, so I think to get to about 15 times, I think that's a healthy one in terms of it'll be constructive to start coming back into the market. If that's what I would do as an investor, to kind of say that, okay, maybe it's washed out now at this point. Even though the stock market's coming down, still doesn't feel like it's washed out. If you see the VIX volatility index, it's still not, hasn't blown out to 50 or something. It's still around 30 and less. So there is no fear factors as such that comes with such kind of slowdown. So we haven't seen that yet. So I think there's still more to go down. But at some point, there's going to be a flush, and multiples will come down. 15 times forward earnings is a good point kind of stepping in at this time. So we're getting there. I think that's what India should also do. I mean, look at the multiples. Don't go for growth yet. Wait and see. Let the multiples come down a bit, and then start coming back in. So right now, go with the defensive, dividend-paying stocks, companies that have pricing power and earning power in this market. Stable companies, and industrial companies, in your case, pharmaceutical companies. So these are companies that will be good around all the time. So I think I would go in there. Financials will pick up as the interest rates keep going up. So that's another area. But I think just be selective, take the best of breed in each one. No speculation at this point.
Okay. Let's say there is a recessionary situation because fears are real. We've all agreed upon that. Let's say is that it does happen. How bad could it be this time around? Especially if we look at what happened back in the financial crisis of 2007 2008, because that was credit driven. This time it's going to be inflation driven. So what will be the difference or similarities, if any?
Yeah, I mean, I can give you from the US point of view, and you can relate it also to the Indian point of view. This time is different, even though people don't like that word, but this time appears to be different because the consumer is strong. Overall, the retail market, there's about 2.5 trillion, according to some estimates, that are still there, that they have accumulated. So that's still in the hand. So the liquidity or the credit worthiness of the consumer is still strong, unlike in 2008 because of the housing crisis and all that. We don't have that kind of a hit to the market, no structural hit to the market as such. So now it's all a question about managing the expenses at this point, controlling inflation, controlling the price of things. And then we have an election year coming up, this election coming up in November. So I think there will be some positive effect, hopefully, of that in terms of reducing prices. As happens with any party that's in power, they will try to make things favorable. So let's hope that things will improve in that sense. But inflation is bad; it's going to be there for a while, and normally they stay for a while until things change. This one was induced more, or rather spurred up more, with the war situation, with the China situation, the COVID situation. So there were just some factors that could not have been controlled, could not have been factored in originally. If the impact of those settle down or moderate a little bit, I think that should slow down the inflation effect. Other than that, it's supply demand internally. things were still hot even before the war and all that. So I think that it needs to get corrected, and you'll see that correction coming forward. But that's there. Recession may not last. We may not even go into a recession. Maybe it'll be a slowdown and then back up. But we don't know that. It's not a given yet. So
Yeah.
let's hope that things improve.
Okay. While I was reading up before our conversation today and even yesterday, I came across several reports which talked about earnings recession. You were saying that, companies are still, watching what's happening, and we should wait for another few weeks to see what the commentary will be like and what the earnings will be like. But are there any indications that if Fed continues its hike rates, which typically accelerates further in an economic recession, could there be an earnings recession? And by that I mean, when I say earnings recession, is a period which incorporates, when corporates have earnings downgrades or profits below the earlier level for two consecutive quarters. So is that a scenario that we could be looking at this quarter or the next?
Absolutely, we could be. You just saw a few companies, Restoration Hardware, yesterday. I mean, they had just announced their quarter. They said things are okay. We can manage it, and then in 2 weeks, and within a week, they come out and say, no, things are very bad. So I think you're going to start seeing that more and more. We saw that with Target. We saw that with Walmart. People are going down the cost curve and buying cheaper stuff, alternate stuff, store brands, things like that. We're seeing a lot of those things coming manifest itself. So things will continue to slide down. Uh, I forgot your bigger question. I mean, what are they saying? Where are we going?
Are we looking at
Oh
an
yeah,
earnings?
the earnings. Yeah, so I think that will be an important thing to see whether we get that earnings recession. I don't think we'll see it immediately because, like I said, the consumer so far is still relatively healthy. But going forward, I think he's going to stop buying, and things, the demand, the forecast, more than the absolute numbers for the second quarter, it's going to be the forecast. What are they expecting down the road? And things are expected to slow down, and summer is seasonally a slow period. But we have to see. I mean, if you see the travel stocks, you would think that will go up in all the. No, they're all coming down. So people are afraid. They're taking their first vacation, their revenge vacation, and then saying that's it. It's too expensive, too inconvenient, nothing's working. The airline's getting canceled. So all those things are also not helping the economy to come back. So you're going to see a lot of that disruptive effect. The economy is going to slow down. So I would say that you'll see the forecast, all the forecasts essentially come down. People are going to say, we don't know what's going to happen. It's going to slow down. We're going to be cautious. We're going to lay off. We're going to cut back. We're going to preserve. We're going to strengthen our balance sheet by holding on to capital. So things like that. You're going to see that kind of commentary throughout and across the verticals. It's not just the tech. You're going to see all of them. And that's going to be the name of the game. And people are going to park their money and either hold on to cash or highly liquid dividend paying stocks. I think that's going to be the name of the game, and you're going to see a lot of those come out.
Do you think? Do you think the central banks ignored inflation for far too long, perhaps because it has been panning out for quite some time, and a significant part of this inflation has been born out of supply chain constraints? Can rate hikes fix that?
Absolutely. I mean, you've heard that word so many times. The Fed is behind the curve.
Yeah.
They thought everything was transitory. They thought it'll just go away. And even though a lot of people, even we thought that day to day life, you could tell nothing was transitory. Everything was going up and up and up. So I think there was nothing that the Fed was mistaken. It did not help that on the fiscal side, when the Biden administration pumped in money also, and gave too much money into the market, brought too much money. So I think all those things, there were mistakes done. There were policy mistakes both on the monetary side and the fiscal side that really affected the whole market. That they should have let the market settle, do its thing. So, but you know how it is. The ruling party or whatever, the party in power does not want to see things go wrong, and you have the political pressures. But overall, net, I would say yes, they were totally behind the curve. They induced most of it. They should have controlled. They should have raised rates long time back, and not have to do this sudden shock and awe thing now that they
Yeah.
plan to do.
In fact, Anubhav is also back. Let's bring him on board. Anubhav, we were talking about the different aspects that have been playing out, which led to soaring inflation, spooking the investors, and what could be the way forward. But if we look specifically at the Indian market, how are the valuations looking right now? Because many of these stocks, many of these indices and sectors are very close to their long-term averages right now. So, what should be the approach?
Right. So, yeah, you're right to say in last 6 to 9 months, there has been a significant correction. And correction has been substantially if you're talking about broader indices, particularly mid caps and small caps. Valuations have come down. In a way, I can say that the valuation froth, which was visible last year, has kind of diminished. Most of the metrics are pointing that now indices are very close to long-term averages, which is also saying in a way that it's not very compelling valuation right now. So it's not a situation where one can aggressively add on to the position. But of course, it is at a situation wherein if a person is looking to construct or reconstruct the portfolio for a very long term, like 8 to 10 years, 5 to 10 years, one can selectively look at pockets. One can selectively look at pockets. But why it is not a place to be aggressive on, because of the context we are talking about. Right now, I think it would be right to, when one is reconstructing the portfolio, it would be right to avoid sectors wherein some kind of competitive dynamics of worsens. Whether it's a space like paints, Siemens, diagnostics, a space like that, commodities, and then be selective about pockets wherein the valuations are reasonable, balance sheet is leaner, cash flow is more steadier, and so there are some pockets, for example, an IT, specialty chemicals, financial, where one can look at. But having said that, as I said, the valuation rating, the rating which we have seen so far is more a function of the central bank action so far, as well as the margin compression. So far, what has not been discounted is, of course, the earning downgrades or the demand destruction, which is yet to be seen. And those are one aspect of the things, and there are few aspects which, on the macro side, which investors should keep a watch on, which could be kind of economic accidents, so to say. For example, Bank of Japan is going to do as far as its yield curve control policy is concerned, whether it will lead to unwinding of yen carry trade, so to speak. And then, more than US, I think it is the eurozone one should be looking at, as far as the probability, high probability of economic recession, and the the fact because of that to the other parts of the world. Because eurozone is in a very typical situation, wherein though they are facing prospect of economic slowdown, high inflation, but they're also having a prospect wherein the last part of the manufacturing sector could be operating at suboptimal level, just because of possibility that the sourcing of feedstock would be suboptimal. So that those are the areas to look at right now.
And when all of these factors are playing out, even the rupee has been on a downside for the last many days now, actually. And that is something that's also, making the investors back home very jittery. So, what is your assessment of the way the rupee is also trading? Should we expect a further downslide, and how will that impact the sentiment and some sectors as well? If you could flag off that could actually gain on the other side from a falling rupee.
Traditionally, of course, the falling rupee provides a bit of a tailwind to export-oriented sectors. So IT per se, specialty chemicals per se, there are few sectors which can benefit. But as I said, we also need to be aware about which geographies those sector or those companies they are catering to. So relatively, I would be less positive on companies which are marked to say demand is eurozone compared to US. US, of course, there is a bit of a slowdown, the kind of parameters we are tracking, we are talking about. But still, having said that, we should also understand this. I mean, having said that, all said and done, as far as the the lower numbers of household spending is concerned, if we see in a larger context, the aggregate personal consumption expenditure is way higher than the trend line which it was before the pre-COVID. So still, on a month and month or YOY, probably the numbers are moderating, but in aggregate, the demand situation in US is still strong. So to say, compared to other parts of the world.
Okay, all right. Santosh, when we talk about periods like this, periods of extreme fear, typically what equity investors do is that they buy when fear, or they should ideally buy when fear is at its highest point. That's what a lot of market watchers, market veterans have been telling us all this while. So, are we near the peak yet or not? What do you think?
Well, it's tough to say. I think the equity market, I think, still has little ways to go down. If you just look at the technical experts, technicians, and also just the fundamental analysts, definitely thinks there's more downward pressure. So there is more room to go down. But I think the worst is probably behind us. And I think in that sense, because a lot of it was speculative, the froth in the market maybe has come out. I think at this point it's more about positioning and all that, and kind of cutting. People have already started cutting back, uh, but I would say that there is more to go. I think at this point you can start seeing that people have already started moving money out of here. In one sense, people are going towards safety, I could say. So you can see the I bonds, especially in the US, which is it pays 9%. It is a limited investment, but you can see there was an article the other day in the journal as well how people are moving towards the I bond, which gives you 9%, which is tagged to inflation. So I think people are worried about return off capital rather than return on capital. So they're moving away. They're getting very defensive, and that kind of spills over. So if everybody starts getting very defensive, there's a cooling down effect on the stock market. So you're going to see that come down. The fall is going to be there more and more. But I think the earnings report, people are waiting for two factors. One is the GDP report that comes out, one is the earnings reports that come out to get a final signal whether we are already deep in the recession or slowdown camp, or there are just early signs. This is just, it's not going to be as bad. Things are going to keep improving because the outlook will get better. Because overall, originally coming into the year, the second half of the year was expected to be stronger. That was a given. People knew that. So I think hopefully that view is not gone yet. So if the Fed slows down, it doesn't get that aggressive, and rates are the market does whatever they want to do, and companies are relatively strong. I think we'll see the inflation, the stock market kind of settle down around here, maybe another 5% lower, 5 to 10% lower, but not fall off the cliff totally.
And how about the bond market? What's your reading there?
Yeah. I mean, you're seeing the bond market go up and down. The yields went up, shot up because people thought the inflation worry was very much. It's a long way to go. Then the bond market, the yields came down. So I think people were not that much worried about inflation as much as thought. So I think there's what bond market is also giving mixed signals. I mean, the 10-year goes from 3.5 down to 3% to 2.9. So it's going up and down. So I think at this point looks like it's around 3%. So it's kind of in a position where people are saying, okay, maybe inflation will be controlled down the road, and things are settling down. And if the yields start coming down, I think you'll see a rush to the bond market as you start. I mean, if people come to the bond market more and more, you'll see the yields coming down more and more. That's a sure sign that people are not really worried about inflation as much as before. So I think that's the whole thing. Everything hangs on the Fed. People want to see them do the right thing. The market wasn't very sure in the beginning, but now I think at these rates right now with the 2-year and the 10-year, looks like the market is kind of accepting that things may not be as bad as thought. So let's wait and see. It's still not a definite sign anywhere.
Anubhav, what is your verdict then? For retail investors, what should we do right now across different asset classes? Where should you park the money, and how much money to park where? I mean, across different asset classes. If I were to, start a portfolio today, what should it look like?
So clearly, right now we are in a situation where there's a long-term case for both bonds and equities right now.
We are not yet in a position wherein we could say that 80-20 can be done for equity. That kind of a compelling valuation is not there. But I think equally one can look for both equity bond and have some kind of a parking as well as gold is concerned for a hedging thing. So also, one thing I just wanted to point out that the kind of economic slowdown which we are seeing now, as far as the US is concerned, and as well as and that's true for other parts of the world as well. One should understand that this is now as per the design. This is what central banks want. The option is just between soft lending and hard lending. So as we move forward, I think we will get this kind of news flow that there's a higher probability for recession because the economic recession probability models are built in that way. Obviously, this slower macro data, which are high frequency in nature, will feed into those forecasts, and the probability for such kind of scenario will come up. So it's a given thing. It's all about whether the US Fed is holding what it is doing right now. Currently, it is totally focused on the headline inflation number. Even the core or inflation data, which usually it used to look at, is moderating a bit. But since the usual transitory element like energy and food are more stickier, so probably they would be looking at more compelling evidence as far as headline inflation is concerned. So coming months are quite tricky, so to say. So, for example, the PC inflation, the headline number is still the same as it was last month. Core inflation data has, though, moderated a bit. But now the US Fed, of course, would be looking at the next set of data, which is coming as far as CPI is concerned.
Hmm. Okay. Santosh, just one last question before we let you go. Equities, debt, gold, or any other asset class perhaps. What do you like best right now? Where are you placing your bet?
Well, I'm not putting in new money in the equity market. I definitely not. So, I mean, if you, gold is a good hedge. I don't do bitcoins because I don't know what exactly what is the intrinsic value of that. So, but I think gold is a safe place. Anything where you can just park your money. That's the operative word. Where can I park my money at this point? Everything is going down. You cannot hide anywhere across the board, and I'm sure that's the situation in India as well. So things are just getting hit everywhere. I would say just hold on to cash as much as you can, or just maybe put money in gold if needed. But other than that, I would say even like for instance, the real estate market is down. Energy market was expected to hold up. That is being pulling down as well. So I think it just seems like there is nothing where you can park your money. Hold on to your cash as much as you can because there are going to be good entry points at a much lower price point. So you can good entry points later on. And then if you're invested, keep it there. Of course, don't panic and sell anything. Market will come back eventually. But at this point, just stay put, hold on to cash, put your money in gold if you have to, but don't rush into the market because you're going to get excellent entry points down the road.
Well, here's hoping that things are available at better price points going forward, and we are pretty much hopefully close to the peak or close to the bottom rather, the
Bottom.
way the markets have panned out. But guys, it has been insightful chatting with you. Thank you so much
Thank you.
for joining in, both Santosh as well as Anubhav. Always a pleasure having you all on board. Right now, of course, we're looking at the US numbers. The first quarter book numbers are already in the book. Economy shrank at 1.6% annual pace based on the final update that we have. Second quarter, not looking very great either right now, but let's see how things pan out. We'll have to wait and watch. This is all from us on Markets Weekly. Thank you so much for tuning in. Have a
Thank you.
great weekend.
Okay.
Thank
Thank
you.
you. Thanks for having me.